Hello everyone, my name is Radovan Vojtko, I'm CEO and the head of research at Quantpedia, and today I would like to discuss technology stocks. So everybody talks about technology stocks and gold at this time. So we are in October 2025. Gold is making new highs, but the Nasdaq and tech stocks are also making new highs. We have a very strong performance, strong bull market in the tech stocks. We in Quantpedia decided to run an analysis to check whether we can profit from that outperformance of the technology stocks against all of the other sectors, and if there is some systematic way how to capture such gains. This is not the first time that we have this domination of few technology driven stocks, so the whole market is dominated by those few stocks. A similar dominance occurred during the Nifty 50 era, so it was in 1960s, 70s. And then we had the dot-com boom in the late 1990s. So this is the third time we have such dominance of the tech sector. Yeah, we had other sectors in the past, like railways and canals and automobiles, etc., etc. I mean, in the last 150 years. But for the tech stocks, this is like third time in the last 60 years. So our question was, can we somehow predict when the tech stocks outperform all of the rest of the stocks, or if we can predict, can we profit from that?
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
What is our methodology? So we downloaded the data from French database. The advantage is that we have a data from 1926. So what does it mean is that we have a data for nearly 100 years. Our proxy for the IT sector is the business equipment sector industry, and we downloaded the 12 industry portfolio. So there are also other like non-durable goods, durable goods, manufacturing, energy, business, telecommunication, utilities, etc., etc. Those are all of the sectors that are defined in French. We picked one of them, which is business equipment, which is proxy for the IT sector. Okay, so in the first case, we built some benchmarks. The first benchmark is the average of all 12 industry portfolios, which is equally weighted or market cap weighted benchmark. Then there is average of 11 industry portfolios, which exclude the technology sector. And third benchmark is the technology sector alone. And this is how does it look like. So the technology stocks are the green one. And here we can see, so there was a run up in the prices in the 70s, which I mean is not exactly in the data, but I mean it was there. Then we have the run up in the prices in the 90s, and right now we have run up in the prices from 2020 up until 2025. The benchmark chart here is zoomed from 1970s until 2025, and here are all of the charts, all of the sectors for other periods. As we can see, I mean from the table, the benchmark, the 12 industry portfolio has a performance around 11%, and technology sector outperforms it a little, just by 0.5%, but it has significantly higher maximum drawdown and standard deviation. So I mean the Sharpe ratio and the Kalman ratio of the technology sector itself is not better than the average of all of the other sectors. This is something which is surprising, but yeah, you can gain more money when you invest in the stocks, but you must invest in them in the right situation, in the right time, because otherwise you have higher drawdowns, higher standard deviation, higher risk than just holding the broad market. Very quickly about the technological evolution. So the first one was in the 60s and 70s, the rise of early computing giants such as IBM, driven by innovations like the first microprocessors, etc., etc. The second wave came in 1990s, dot-com bubble, of course, expansion of the index fund derivatives, computing technology, internet, etc., etc. So nothing surprising. And in the late 2010, 2020, we have companies such as Apple, Amazon, Google, Microsoft, Facebook, and Nvidia at the moment. So and in the recent years, it's artificial intelligence that's fueling the market. Okay, so the question is, will the current bull market in AI stocks end the same way as in the past? So what does it mean is that the tech stocks boomed and then they had the bust. We will see at the end. So this is how does it look like when we compare the performance of tech stocks versus other sectors. So here we can see the bull market of 60s, 70s. Here is the bull market from 90s. As we can see, I mean in 90s it was like clear peak going up and down. In 70s it was like more years, like decade of going up and then 1 or 2 decades of going down. And right now we are here. How long the outperformance will last? That's the question. I mean, we do not have the crystal ball, but there are some systematic ways how we can profit from that and then we avoid the bust. Okay, so the first thing we try to do is to build a moving average strategy. So we took this spread between tech stocks and other sectors and we try to systematically profit from it. And what the quick overview or freak result, there is no easy way how to profit from the difference between tech stocks and other sectors. We try to time that outperformance using the moving average. You are performing well when there is a clear trend of the technology stocks outperforming outperforming or underperforming, but if there is a sideways market in the spread between them, like here at the bottom or here, you are losing the money trying to time tech sectors versus the other sectors. Overall, the performance of that system is not very useful, so we are moving on. So then we tried the long momentum strategy. So what does it mean? So we compare the momentum of the technology sectors and the other sectors, and we use the momentum ratios from 3 months to 12 months. And the idea was, if the technology sector momentum is higher than momentum of all of the other sectors, then we invest into the technology sector. Otherwise, we invest into the average of all of the other sectors. So we are switching between tech stocks and the rest of the market. So here we have a benchmarks, and here are the performance and risk return ratios. What is the takeaway? Using the momentum, you are able to switch between the tech stocks and the other stocks. You will have a little better performance. So the benchmark is around 10 to 11%, and I mean the strategy using momentum has between 12 and 14%. And on the other hand, you have higher risk. So the Sharpe ratio, Kalman ratio is the same as holding the index. So you are just having higher performance because when you use the momentum, just switching between tech stocks and other stocks, you are loading on the technology beta when they are going up, but you are a little late when you try to switch into the other sectors, so you have also the higher risk. So I mean, at the end, it doesn't make sense a lot. Then we tried the long short momentum strategy. How does it work in a long short momentum? Once again, if the tech stocks outperform all of the other sectors, we go long techs and we short the average of all of the other sectors. And if other sectors outperform the tech, we go long other sectors and we short the tech. This is a spread strategy between tech and the others. Because it's spread, it doesn't have very significant performance, so the performance is between 1% to 2 or 3%. It has zero beta on the market, so this is just alpha. So here you can see just alpha of the performance, and what you can see is that when you try to go long the tech and short other sectors, you are outperforming only at the times when there is a bubble in the tech sector. So it was in the late 60s and beginning of the 70s, so it was the first bubble, then in the 90s the second bubble, and right now in the third bubble. Otherwise, I mean, your performance is flat. Nothing very useful. What was the other idea? So the tech stocks outperform from time to time, but there are also other 11 sectors. What if we do not try to predict when the tech sectors outperform all the 11, but what if we rotate among the best sector, and no matter if it's tech or some other sector? This is a clear momentum, so we are buying the best performing sector from 3 to 12 months, so it depends on the momentum calculation window. We can pick multiple momentum calculation windows, and we are investing into that best sector. So what are the results? So firstly, we have the performance that's clearly better than just selecting the tech as the sector which we will invest. So it's better to rotate among the winning sectors. Do not be fixated on the tech. When you want to invest into best performing sector, pick really the best performing sector from all of the sectors, not just the tech. So in this case, we have a higher performance. The risk is relatively the same as the risk for the benchmark. So our Sharpe ratio and Kalman ratio are better. Not significantly better, like twice better, but they are better. So we have 5 to 6% higher performance. So the risk is approximately the same. So the Sharpe ratio is a little higher and the Kalman ratio is also a little higher. This is a good idea. It makes sense to invest in a bubble. Do not strictly try to invest just in a tech bubble. Be flexible. Pick really the best performing sector, no matter which one, and hold that best performing sector, even if that's utilities or healthcare. Okay, then we try to quantify what is the performance of the long short rolling basis strategy. What is the long short? So in this case, we are just trying to capture the alpha. So we are going long the best performing sector, and we are shorting all of the other sectors. So in this case, we are trying to capture the alpha and quantify what is the. So this is pure alpha performance. There is no exposure to the market. So what is the alpha performance? So we tried windows from 1 month momentum to 12 month momentum, and the performance is from 2.5% up until 5%, which is interesting. So 5% alpha with 50% maximum drawdown. Yeah, we have Sharpe ratio 0.3 and Kalman ratio 0.1, but on the other hand, this is completely market neutral strategy. So that's nice. The longer horizons, so using momentum in the range from 8 to 12 months, are more effective than shorter ones. So I would advise using the longer window for calculation of the momentum, but shorter windows are fine. So at the end, we can have some momentum strategy. The question is when this momentum strategy really works. So for that, we try to build average momentum strategy. So we took the average of all of the 12 strategies in the table here, and we build average momentum strategy. So that's the strategy that divides portfolio into 12 parts, and each 1/12 of your portfolio is managed by a momentum strategy with a window from 1 month to 12 months, and this is average long-short momentum strategy. And we were interested to see what are the patterns in the performance and whether we can time that momentum strategy, so if we can find out when this momentum strategy performs the best. Here is the result. Strongest line is that average momentum strategy, and what we can see that there is a clear pattern. We have a very nice alpha and performance up until 1970s, plus or minus, or 60s, 70s. The reason for that is that this is the strategy based on Fama French data, and up until 1960s there was no easy way how to invest in the sector as a whole, so you had to pick the stocks themselves, etc. I mean, this is like pure theoretical alpha. And from 1960s, 70s they started to appear some sector funds, etc., etc., so it was easier to invest into them. But what you can see is that there are like clear free periods when this momentum strategy once again works the best, and it's in the late 70s or 60s, 70s, then in 90s, and once again after the COVID era. Once again, first bubble, second bubble, third bubble. So what does it mean is that even that we are having the long short strategy, the strategy works the best when there is a bubble in the tech stocks. So I mean, yeah, at the end, it's highly correlated to the bubbles in the tech. So if the bubble in the tech will continue, you will continue to profit. If the bubble in the tech ends up, stops, the momentum strategy will probably not gain a lot of the money. But then we try to somehow time when it's best to invest in that strategy, and we try to time it using the, let's call it the 12-month momentum max strategy. So what was the idea? So we tried to use this strongest equity curve and use the 12-month high, and if we are at the high of that curve, we will invest into the momentum strategy for the next month. The second idea was, if we are in a positive trend in the momentum strategy, then we will invest into the strategy. So it was the 12-month moving average momentum. So here we have a benchmarks. As we can see, the pure momentum without timing was the best one. When we tried to time it, it was not performing very well. It's very hard to time the average momentum strategy, so it's very hard to say when the average momentum strategy will work the best, or the momentum itself will work the best. So the bubbles are predictable, and if you want to profit from the bubble, you simply have to follow the momentum strategy all of the time and just hope that there will be in the bubble in the past. If I would try to recommend something, I would probably recommend just the simple buy the best performing sector over the last 12-month period. You can short the rest, hold the portfolio for 1 month, and this is probably the simplest approach and the best approach to exploit the cross-section momentum and profit from the bubbles. And right now at the moment it can be the technology stocks that you will be holding. In the future it can be other stocks. However, you will probably outperform the market only when the tech stocks themselves will perform well. Will they perform well in the next 2 or 3 years? I am highly skeptical about that, but I really think we are in an AI bubble. It's fueled by a lot of the promises, a lot of the expectations. I do not think the tech stocks will outperform all of the rest in the next 2 or 3 years. So in this case, I'm not exactly sure that the momentum approach to sector allocation is the best one, but on the other hand, I would rather invest using the momentum than just buy the tech stocks themselves, because I am afraid that the tech stocks will have a bear market in the next 1, 2 or 3 years. So I would rather use the momentum strategy than just invest into the techs themselves. Okay, thank you very much. I hope that you like these analyses. The whole article is available on our blog, so feel free to visit our blog. Also, do not forget that we have a lot of the analyses on our blogs, similar like you saw, and we have like more than 1,000 strategies in our database. There are momentum, trend following, reversal, arbitrage, option trading, and a lot of the other strategies in our database. So feel free to visit also our screener, and I hope that you will join me in the next video. So thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.